Hello and welcome to our session on monetary reform, gold, and bills of exchange. This will be the start of your paradigm shift from finance to commerce. Professor Antal Fiketty has done an awesome job in this document, allowing us to fully understand the history of gold and bills of exchange from the 12th century to 1909, when it was eliminated from the system and finance was introduced, and ultimately in 1971 they took gold away from all of us. And this is where we got into the buy now, pay later, get you into debt forever and ever plan with easy credit. So very important. Again, watch this, read this as many times as you possibly can, because this will give you the firm foundation that there always has been, a superior way of doing business. Not through finance, not borrowing money, but using gold, bills of exchange. And we have all that in place right now for you to participate in. So it's very important that you internalize this material, make it a part of you. That's the hardest part of a paradigm shift. And I hope you're not stuck in paradigm paralysis and you're not going to move forward, because that would be tragic. All right, well, let's get started on this document. It's fairly long. All right, so here we have Monetary Reform, Gold, and Bills of Exchange by Antal E. Fiketty. It was addressed before the Civil Society Institute at Santa Clara University on November 3rd, 2008. This is his introduction, and it's very important to understand the history behind everything that's gone on and happened to us. Now, in the articles from the Federal Reserve from Chicago and the Real Story of Money that you've read, I didn't bother to do webinars on those. They're too lengthy. You'll just have to take the time to read them. But this one I want to read, because you've got to listen to this, use the How We Learn and Retain Information protocols to internalize this. You really have to. So the Great Depression of the 1930s was not due to the contractionist propensities of the gold standard as alleged by John M. Keynes, nor was it due to fractional reserve banking as alleged by Murray Rothbard. And again, that article goes into the details of fractional reserve banking. Rather, it was due to the government's sabotaging the clearing system of the international gold standard, the bill market. Well, the good news is the Internet Catalog Club has been working since 1996 to reintroduce the clearing system, and we have our own gold standard, and we have our own bill market. It's already in place. It's being used now, and you can participate in it. So read this and enjoy. Adam Smith's real bills doctrine reigned supreme in monetary science throughout the 19th century, and rightfully so. It explained how it was possible to refine the division of labor and to lengthen production processes in making them more roundabout, in order to improve the efficiency of labor and capital, without causing monetary contraction through unnecessarily invading the pool of circulating gold coins, and without tying up savings in order to finance circulating capital. It also explained the miracle how weekly wages can be paid to workers whose products will not be sold for perhaps as long as 13 weeks. Clearly, additional fixed capital can only be financed through increased savings. Additional circulating capital, however, need not involve savings. It can be financed through improvements in clearing. Circulating capital can be self-financing, provided that the goods involved are demanded urgently enough by the consumers. In this address, I look forward to the release of the gold standard from a 40-year quarantine, to become one of the pillars of reconstruction after the present credit collapse has run its course. Now remember, 1971 to the present is more than 40 years now, and we're going to start to see through the Basel III compliance of banks that all banks are required to have some kind of backing of assets in gold, precious metals, or oil, or some other valuable commodity that will back. And so we're right at the right time in history, and we do this privately ourselves. We don't need banks to do it, although we welcome their participation. But this is so very, very important for you to grasp. So in order to be viable, the new gold standard has to have a valid clearing system, and we're leading the way with this valid clearing system. Bill circulation would spring up spontaneously. In other words, we would have a gold standard of the type that prevailed in the world prior to 1914, when international trade was financed not through gold flows across national boundaries, but through the trading of bills of exchange drawn on London. It would not be a gold exchange standard as the years between 1920 and 1971, with government promises to pay replacing real bills, but it would not be Murray Rothbard's so-called 100% gold standard either, which is phantasmagoria. Now, the key to this is what's called self-liquidating credit. In spite of obvious differences between the two, it's customary to extend the concept of credit to include clearing. In more details, in addition to credit arising out of the propensity to save that finances fixed capital, we also consider self-liquidating credit arising out of the propensity to consume that finances circulating capital. The latter does not involve lending, it involves clearing. I'm going to say that again. The latter does not involve lending, it involves clearing. Goods making up circulating capital must be in the final phases of production and distribution, and they must move sufficiently fast to the ultimate gold-paying consumer. Thus then, the bill of exchange is the embodiment of self-liquidating credit, so called as the credit is liquidated directly with the gold coin surrendered by the consumer in 91 days or less. 91 days being the length of the seasons of the year in the temperate zones, forcing a change of the type of merchandise in greatest demand. You can see that in northern North America, where we go from winter to spring to summer to fall, and clothing changes in all of those seasons. And so that gives you the cyclical demand. Now, detractors of the real bills doctrine studiously avoid reference to its prestigious pedigree and its author, Adam Smith. And if you don't know who Adam Smith is, go look him up, Google him, and ask about real bills doctrine in Google or one of the search engines. They also ignore the fact that as a matter of merchant custom, producers and distributors hardly ever pay cash for the maturing merchandise as it's passed on from one hand to the next. Instead, they endorse the bill of exchange, and in doing so, assume liability to pay it at maturity. This transaction is called discounting, as the payee applies an appropriate discount calculated at the current discount rate to the face value of the bill, proportional to the number of days remaining till maturity. Banks need not be involved. I'm telling you folks, this is so very important for you to internalize and make that paradigm shift. The chicken or the egg? Such a bill circulation was universal in the city-states of Italy during the Quattrocento, and more recently in the 18th century in Lancashire before the Bank of England opened up its branch in Manchester. This was duly observed by Ludwig von Mises in his 1912 treatise, The Theory of Money and Credit, although he stopped short of investigating the economic forces animating spontaneous bill circulation. And like the question whether chicken was first or the egg, the question whether bills or banks came into existence first has a different answer. Logically and historically, bills predated banks. I'm going to say that again. Logically and historically, bills predated banks. What is more, it is perfectly feasible to have an economy without banks, where circulating bills emerge as suppliers deliver semi-finished goods to producers. Instead of recognizing this fact, detractors link bills and banks as if they were Siamese twins. They are not. A fairy tale. Let us look at another historical instance of clearing that was vitally important in the Middle Ages. The institution of city fairs. The most notable ones were the annual fairs of Lyon in France and Seville in Spain. They lasted to a month and attracted fairgoers from places as far as 500 miles away. People brought their merchandise to sell and a shopping list of merchandise to buy. One thing they did not bring was gold coins. They hoped to pay for their purchases with the proceeds of their sales. Let's pause for a second and think about, why wouldn't they bring gold coins? Middle Ages, highwaymen, robbers, they didn't want to lose their gold coins on the way. Now this presented the problem that one had to sell before one could buy. But the amount of gold coins available at the fair was far smaller than the amount of merchandise to sell. The fair would have been a total failure but for the institution of clearing. Buying one merchandise while or even before selling another could be consummated perfectly well with the physical mediation of the gold coin. Naturally, gold was needed to finalize the deals at the end of the fair, but only to the extent of the difference between the amount of purchases and sales. In the meantime, purchases and sales were made through the use of scrip money issued by the clearinghouse to fairgoers when they registered their merchandise upon arrival. Now, those who would call scrip money credit created out of nothing were utterly blind to the true nature of the transaction. Fairgoers did not need a loan. What they needed and got was an instrument of clearing, the scrip representing self-liquidating credit. Wow, this is awesome. Goods in bottoms. Another example of clearing in action is the world trade prior to 1914. Suppose a cargo ship is ready to sail from Tokyo to Hamburg, carrying in its bottom consumer goods in urgent demand. The sea voyage takes up to 30 days with several stops en route. Does the importer need to raise a loan to pay the supplier for the goods in the bottom prior to sailing? Hardly. The merchandise has a ready market upon arrival, and the cargo is insured against losses at sea. Accordingly, the supplier bills the importer for the received value, FOB, Tokyo, payable in 30 days in London. The importer endorses the bill, attaches the insurance documents, and sends it back to the supplier. The boat is now ready to sail. The supplier has an instrument he could use as ready cash to pay his own suppliers, or he can keep the bill to maturity as earning asset. When the boat docks in Hamburg, the local wholesale merchant pays for the cargo with a sight bill on London, with which the importer can meet his maturing obligation. No loan or lending is involved in all this, only clearing. The pool of circulating gold coins has not been invaded, nor are savings tied up for 30 days, while goods in urgent demand move from the Far East to Western Europe. The tale of the cuckoo's nest and egg. 1909 was a milestone in the history of money. That year, in preparation for the coming war, the note issue of the Bank of France and the Reichsbank of Germany were made legal tender. Most people did not even notice the subtle change. Gold coins and banks kept circulating as before. It was not the disappearance of gold coins from circulation that heralded the coming destruction of the world's monetary and payment system. It was the advent of legal tender. It was the French and German governments' decision to stop paying civil servants in gold coin who were now forced to accept paper money. Private firms immediately followed suit. They also started paying their employees with bank notes. Never mind that the bank notes were redeemable in gold coin. This change effectively meant sabotaging the clearing system of the international gold standard nevertheless. In short-circuited bill circulation, bills were supposed to be paid at maturity in the form of a present good, the gold coin obtained from the consumer, who in turn was supposed to get paid in gold by his employer on an every payday. Now they were paid in the form of a future good, the banknote. Legal tender coercion created an irreparable leakage in the gold circulation process. The banks continued using real bills as an earning asset to back the note issue, but other subtle changes were to alter the character of the world's monetary system beyond recognition. Unbelievable. Well, believe it. This is history. You're reading it right now. The cuckoo has invaded the neighboring nest to lay her egg surreptitiously. In addition to banknotes originating in bills of exchange, banknotes originating in finance bills, including treasury bills, have made their appearance for the first time. In due course, the cuckoo chick would hatch and push the native chick out of the nest. In 5 years, by 1914, the lion's share of bank portfolios would be replaced by finance bills. The real bill has become an endangered species. In another few years, it became extinct. Note that unlike real bills, finance and treasury bills are not self-liquidating. The changeover from banknotes backed by real bills to banknotes backed by finance bills was the last nail in the coffin of the clearing system of the international gold standard. So why did it take so long to reintroduce this? 1996 through till now, not done by any governments, not done by any banks, but by private enterprise using commerce through capitalism. This has been an arduous journey, I must say, but we are here at the pinnacle of the release of a clearing system that you and I can participate in right now. Borrowing short and lending long. Finance bills are backed by the odds, never the certainty, that a speculative inventory of goods or equities or investments in brick and mortar may be unwound without a loss. If the odds do not play out in time, the finance bill would be rolled over. And what do you think they do in the fiat currency? They roll over the debt generationally. It can never be paid, and that's why we're going to see a global reset very soon using this new gold-backed currency system brought by the banks, because they purposely did this for massive wealth extraction, and we'll go back to a gold standard. This is tantamount to borrowing short and lending long, an invitation to disaster. Well, the disaster's occurred. By contrast, a real bill is never, ever rolled over. If not paid in gold upon maturity, the drawer of the bill will go bankrupt, and his name will be blacklisted at the clearinghouse for good. Finance bills made the portfolio of banks illiquid. Potential demand for gold coins, should holders banknotes want to exercise their legal right to redeem them, could no longer be satisfied. In fact, in 1971, we went from a US dollar to a US Federal Reserve note, and it was no longer able to be redeemed in silver. In fact, they killed Kennedy specifically because he wanted to reintroduce asset-backed currencies, and that's the real reason. So to take away this right was the reason for making banknotes legal tender in the first place. Redemption would never be a problem as long as the bank's assets consisted of real bills exclusively. Every single day, 1/90th of the outstanding banknotes would mature into gold coins, which were available for redemption. Normally, this would suffice to satisfy daily demand. But what about abnormal demand? Well, a real bill is the most liquid earning asset that a bank can have. At any time, somewhere in the world, there is a demand for it. In particular, banks that have a temporary overflow of gold would be more than anxious to exchange it for real bills. Thus, banks would not have the slightest difficulty to get gold in exchange for real bills in the international bill market. The assumption that there will always be takers for real bills offered is just as safe as the assumption that people will always want to eat, keep themselves sheltered and warm tomorrow and every day thereafter. The chimera of fractional reserve banking. This explodes the blanket condemnation of fractional reserve banking. Detractors are barking up the wrong tree. They should condemn the practice of discounting finance bills. Actually, fractional reserve as applied to banks with nothing but real bills in their portfolio is a misnomer. The reserves are gold plus bills maturing into gold. The reserves are not fractional, and they fully back the note and deposit liability of the bank. By contrast, if the bank portfolio has a component of finance bills, the designation fractional reserve is appropriate. Finance bills are not maturing into gold like real bills are. It may not be possible to get gold in exchange for them when the crunch comes. Reflex. The process of retiring bank notes after the merchandise serving as the basis for their issue has been removed from the market by the ultimate gold-paying consumer is called reflex. Some authors, including Ludwig von Mises, have ridiculed the concept of reflex, calling it deus ex machina. They argued that banks were only interested in credit expansion, not in reflex. Not for one moment would they entertain the idea of voluntarily withdrawing banknotes from circulation when the underlying real bill matured. Instead, they would lend them out at interest again and again to enrich themselves at the expense of the public. Now do you see the mess we're in? This is not a valid argument. For the stronger reason, you could also ridicule the entire legal system in asking the rhetorical question, what's the point of making laws when they will be broken anyhow? You cannot judge the merit of an institution by the behavior of those who are set upon destroying it. The birth of the wage fund. And by the way, we have this in what's called employee gold. It's already in place. The havoc that the silent monetary revolution of 1909 ushered in legal tender banknotes would wreak havoc upon society has not been foreseen. Nor was the causal relation recognized between the expulsion of real bills from bank portfolios and the massive unemployment that followed it. In Germany alone, 8 million people, or nearly 50% of the trade union membership, lost their jobs after 1929. Economists have failed to point out the causal nexus between the two events 20 years apart. Here's the explanation of what happened. Real bills finance the movement of consumer goods, including wages paid to people handling the maturing merchandise through the various stages of production and distribution. That part of the circulating capital paid out in wages is called the wage fund. The birth of the wage fund is due to the real bills market. Without it, payment of workers producing consumer goods would not be possible until the sale to the final consumer. The size of the wage fund needed to move the mass of consumer goods through these stages, if financed out of savings, would be staggering. So what did they do instead? General Motors goes to the bank, borrows on its line of credit to meet its wage needs. And when you have to do that, you're broke. So that's why they got the bailout. Quite simply, it could not be done. No conceivable economy would produce savings so prodigiously as to be able to finance circulating capital that society needed in order to flourish at present levels of security and comfort. The highest achievement of the human spirit and intellect. Fortunately, there is no need to employ savings in such a wasteful manner. Circulating capital can be financed through self-liquidating credit. The discovery of this fact is one of the great achievements of the human spirit and intellect. The impact on human life of the invention of the circulating bill of exchange is fully commensurate with that of the invention of the wheel. I'm going to say that again. The discovery of this fact that circulating capital can be financed through self-liquidating credit is one of the greatest achievements of the human spirit and intellect. The impact on human life of the invention of the circulating bill of exchange is fully commensurate with that of the invention of the wheel. So why did it disappear? Because of one ultimate greedy family called the Rothschilds, who wanted to own the world. Isn't that amazing? So detractors of the real bills doctrine have missed one of the most exciting developments of our civilization. The discovery of self-liquidating credit as it emerges in the wake of the disappearance of risk at the end of the production process when maturing goods get within earshot of the final gold-paying consumer. They have missed the fact without real bill circulation, wages could not be paid in advance of the sale of goods, except under a constant threat of unemployment. And so what do we see today? Unemployment is rampant. It's everywhere. Destruction of the wage fund. This near-perfect system was allowed to disintegrate in the wake of the 1909 legal tender legislation. By crowding out real bills from the monetary system, governments have inadvertently destroyed society's wage fund. Where did they get the direction to do this? Well, from the bankers. All right, so the governments, on behalf of the Federal Reserve System of the United States, destroyed this purposefully in order for the Federal Reserve System to direct all actions of the United States government. Study your history. It was there to allow wages to be paid as much as 91 days in advance of merchandise being sold to the ultimate consumer. When real bills were replaced by non-self-liquidating finance bills, payment of wages has become haphazard. Employment was made touch and go, hiring hand to mouth. This threatened with unemployment on massive scales unless governments were willing to assume responsibility for paying wages. Eventually, to avoid undermining social peace, they had to do just that. So what happened? Governments invented the so-called welfare state, paying out the so-called unemployment insurance to people who could have easily found employment had the wage fund been preserved through ensuring the proper functioning of the bill market, the clearing system of the gold standard. What is hailed as a heroic job creation program appears in the present light a miserable effort at damage control by the same government that has destroyed the wage fund in the first place. Economists share responsibility for the disaster. They never have examined the 1909 decision to make banknotes legal tender from the point of view of its effect on unemployment. They should have demanded that instead of treating the symptom, unemployment, governments remove the cause of the disease, the destruction of the clearing system of the gold standard, the bill market. Had the governments allowed bill circulation to return at the end of the hostilities in 1918, the wage fund would have been replenished at once. Unemployment would not have arisen. Recall that it was not a problem before 1909. Wow. The greatest fiasco of all times. The problem of destroying the clearing system of the gold standard was expelling self-liquidating credit in 1909, and it was further aggravated in 1971 when the gold standard itself was destroyed. Tricky Dick did it to us. By 2008, the festering crisis has become a fully blown credit collapse, encompassing the entire globe. We must have the humility to admit that it was our reckless experimentation with irredeemable currency and synthetic credit that resulted in this fiasco greater than any other man-made disaster in history. The runaway debt tower of Babel is toppling, and the quadrillion-dollar strong global derivatives monster is vaporizing. There is no bottom to this collapse. The financial system is self-destructing. It is in a death spiral. Every wave of losses in the mortgage market, in the stock market, in hedge funds, or the derivatives triggers a new wave of losses. This will continue until total exhaustion is reached. It's futile to expect the Fed and the Treasury to regain control of the careening financial system, even if all the central banks of the world pool resources. There is not nearly enough dollars in existence to cover the derivative losses, despite the Fed's endless stream of bailout money and despite the Treasury's endless stream of bailout bonds donated to the Fed for collateral, which the latter needs but hasn't got, to create more bailout money. Having interest rates again and again is oil on the fire. It's been the main cause for capital destruction and contributes directly to unemployment. The way out. In discussing the necessary monetary reform to be introduced after the dust settled, the rehabilitation of the gold standard and its clearing system, the bill market, must be a matter of first priority. The main cause of the disaster was the elimination of self-liquidating credit from the international monetary system, a process that started in 1909 with the introduction of legal tender bank notes. It took almost a full century for the process to run its devastating course before the financial system started unraveling in February of 2007. That is the date, it will be recalled, when the cost of credit default swaps shot up first, the salvo marking the beginning of the end. During that unfortunate century, the 20th, self-liquidating credit based on positive value gold was forcibly replaced with synthetic credit based on negative value, debt. Once the regime of irredeemable currency was in place, there was no way to rein in the fast breeder of debt in the system. We are forced to draw two conclusions. Number one, there is just no alternative to self-liquidating credit. That is to say, the production and distribution of consumer goods must be financed through bills of exchange. And that is what we are all about in commerce through capitalism, folks. Number two, there is just no alternative to the gold standard. The regime of irredeemable currency is based on debt. Once adopted, the fast breeder of debt is engaged and will before long start spinning out of control, and that's exactly where we are. Now, everything that we do at the Internet Catalog Club is backed by gold, precious metals, oil, natural gas, and patents. Solving the problem of the monetary system will also solve the problem of unemployment. Once real bills start circulating, the wage fund will be replenished at once, out of which wages can be paid to all those eager to earn them for work in providing the consumer with goods and services in most urgent demand. If we want to exorcise the world of the incubus of unemployment with which it has been saddled by greedy governments and banks in making their banknotes legal tender, not only must we return to the international gold standard, but we must also rehabilitate its clearing system, the bill market. In this way, the wage fund can be resurrected. Then and only then can the so-called welfare state, paying workers for not working and farmers for not farming, be dismantled. Well, there we have it. Awesome start to your paradigm shift from finance with using a debt money system, fiat currencies, to a gold-based commerce through capitalism economy that's private, that can't be shut down by governments. They've tried. So come learn with us. Here's all the references. Go read all these interesting follow-ups and read the fine print. All right, that's the end of our first session with Antal Fiketty. There are 3 more. Make sure to watch them. One of the things that you'll see right after this one is a neat little story called the hotel story. And it'll give you, I think, an understanding of exactly what clearing is. It's very simplified and certainly isn't in the detail that we're doing it, but it will have you see that this is going on and can go on, and you've probably already done it. So make sure you watch that little session right after this one. Thank you.